Hello everyone, welcome back to the Stateless Standard, where we're breaking away from donkeys and elephants to find real, genuine solutions. In today's video, we're going to talk more about inflation. This is an important topic, yet mainstream opinion remains naïve to inflation's destruction. So let's dig in. Imagine waking up to find that the home you dreamed of owning now costs twice as much. Overnight. Your groceries up 50%, and your savings silently evaporating. This isn't a dystopian novel, it's the reality of today's affordability crisis. But what if I told you the real culprit isn't just prices going up, it's the money itself? Welcome to the hidden theft, how inflation fuels the affordability crisis. In the next 6 minutes, we'll uncover why inflation is far worse than headlines suggest and how we can break free. Let's dive in. First, let's confront the elephant in the room. Inflation is understated, deliberately so. Governments and central banks measure it through indices like the Consumer Price Index, or CPI, which tracks average price changes for a basket of goods. But over decades, they've quietly tweaked that basket's contents. Think of it as swapping fresh apples for bruised ones and calling it the same fruit salad. These definitional changes make today's prices look less inflated compared to the past. Take Shadow Stats, an independent service led by economist John Williams. They recalculate inflation using pre-1980s methodologies. No substitutions, no sleight of hand. The result? Official US inflation hovers around 3%, but Shadow Stats pegs it at nearly 10%. That's not a minor discrepancy. It's a systemic underreporting that masks the true erosion of your purchasing power. Why? Because admitting the full scale would expose the fragility of our fiat money system, where central banks print currency at will. As skeptics of unchecked state power know, these adjustments rarely go the other way. They only soften the blow to official narratives. But even if we fix the measurements, grasping inflation's true nature is deceptively complex. Forget the textbook definition of rising prices. True inflation, as economists from the Austrian school like Ludwig von Mises taught, is the expansion of the money supply beyond what a free market would allow. Under the gold standard, money grew slowly. Mined gold supply was tied to real costs and demand. If gold prices rose, more miners rushed in. If they fell, investment dried up. It was self-regulating. Today, central banks like the Federal Reserve conjure dollars from thin air. Keystrokes, not pickaxes. This flood of new money doesn't hit every corner of the economy equally. It's like pouring water into a sponge. Some spots soak it up fast, others stay dry. Early recipients, big banks, corporations, spend first, bidding up assets like stocks and real estate. By the time it reaches you and me, prices for everyday essentials have already climbed. This is why money is non-neutral, as Austrians say. Inflation isn't a uniform tax, it's a personalized heist. Your family's grocery bill might spike 15%, while your neighbor's rent jumps 25%. It depends on what you buy, how flexible you are, and where you live. Aggregate indices like CPI offer a blurred snapshot of the economy's average, but they can't capture your story. They miss the quiet desperation of choosing between quality childcare and a family vacation. Inflation doesn't just raise prices, it reshapes lives, unevenly and invisibly. Compounding this deception are quality adjustments baked into those indices. Picture a TV. The 2023 model has a sharper screen and smarter features than its 2010 counterpart. Statisticians credit this improvement with slashing the effective price increase, sometimes treating a $1,000 TV as if it costs just $700 in real terms. But who decides the value of that upgrade? Bureaucrats? Not you. Sellers hype enhancements while downplaying duds, and there's no free market vote on whether a marginally better gadget offsets your rent doubling. Worse, these metrics ignore degradations that sting daily. Ever notice your chip bag feels lighter, filled more with air than crunch? That's shrinkflation. Same price, less product. Or the classic shift, trading ribeye for ground beef to stretch the budget. These aren't efficiencies, they're erosions of quality of life. Yet inflation stats pretend they don't count. Even unchanged prices hide inflation's hand. Natural quality gains from innovation create deflationary pressure, masking monetary debasement. In short, the numbers flatter the system at our expense. Now consider the silent accelerator, compounding. A modest 2% annual inflation doubles prices every 36 years. Your money halved in value without lifting a finger. Bump it to 3%, and that halving hits every 24 years. That's 12 fewer years to save, invest, or simply breathe. Over a lifetime, these small rates compound into catastrophe, turning modest homes into million-dollar mirages and nest eggs into crumbs. It's not hyperinflation's drama. It's death by 1,000 quiet cuts. Here's the good news. Inflation isn't inevitable. It's a policy choice. Return to commodity money like gold or even Bitcoin, and inflation vanishes. Supply ties to real scarcity and demand, not whims. Prices would dance to supply and demand alone. If lumber shortages hike home costs, textile surpluses might drop clothing prices elsewhere. Money's fixed supply prevents across-the-board hikes. Scarcity forces trade-offs. In a thriving economy, we'd even welcome mild deflation. As productivity soars, we invent better tools, farm more efficiently, goods multiply while money stays constant. Result? Prices fall, letting the same dollar buy more tomorrow. Far from scary, this rewards savers. Hold cash, watch its power grow. Inflation flips that script, urging reckless spending on depreciating dollars. Deflation fosters wisdom. Inflation breeds frenzy. State economists decry it as doom. But history, from 19th century America to modern tech booms, proves deflation drives progress. The affordability crisis isn't fate, it's fiat money fraud. By understanding inflation's mechanics, we reclaim our power, demand sound money, question the stats, and build toward a deflationary dawn. What's robbing your wallet most? Please share your thoughts with us in the comments below. If you enjoyed this video, if you learned something, please like, subscribe, and share it with your friends. Until next time, thank you for watching The Stateless Standard. Stay curious, stay vigilant, stay free.